I think it's fair to say that the easy money in the stock market has probably already been made. That is, if there is such thing as easy money, and we all know that there's not. Stocks have had a tremendous run since December of 2018. We happen to be bullish, adamantly bullish during this run. Unfortunately, we are also adamantly bullish the grain markets, which have not fared as well. The grain markets are trading in the exact opposite camp as stocks. While the stock market's pricing in an almost best case scenario when it comes to the Chinese trade deal, the U.S. grain markets are pricing in the opposite. They're looking at a worst case scenario. We're seeing stocks near all-time highs and grains near 10 or 20-year lows in some cases. So both of these markets are at complete opposite extremes, and they're both working off the same premise, that the U.S. and the China trade deal is in the works. Will it be what they expect? Will it not be what they expect? Both markets cannot be right. In fact, we probably think that both markets are a little bit wrong. In other words, both markets are exaggerating the outcome. If we're right about that, we should see stocks roll over and start to soften a little bit, or at least stop going up, and we should see the grains firm up and start moving higher. Taking a look at a chart that depicts both the equity market and the grain market simultaneously gives us an idea of what things really look like in the big picture. So the red bars are the E-mini S&P 500 futures, and the green bars are soybean futures. And you can see the world started learning about the potential of a trade war between the U.S. and China in early 2018, and in the beginning it was probably more talk and less bite. The stock market didn't really believe that there were going to be tariffs put in place. They thought it was all jockeying. The grain market in the beginning also believed that, but eventually came to the realization that this is real. And what happened when the soybean market realized that there were going to be tariffs and it was going to have a tremendous impact on farmers, the bean market dropped from roughly $10.30 or 40 cents per bushel all the way down to the $8 range. So that's obviously a huge, huge move in a short amount of time. And it's not surprising that farmers are having a hard time dealing with these sorts of things. In the meantime, though, the equity market continued along with its uptrend until the end of September, beginning of October, when it started to realize that it too could possibly feel the effects of a trade war. However, after some back and forth and some selling off in both markets in December, the equity market went on its way, and the grain market also went on its way. But obviously they went in the opposite direction. We're looking at the stock market up here and grains down here. In the end, we're seeing the stock market near an all-time high and the grain market, or specifically soybeans, near a decade low. So we have to think that when we look at these asset classes and the way that they're behaving differently to the same information, obviously there's other fundamentals at work here. There's a supply issue in soybeans, and the stock market has other fundamentals, good jobs numbers, the economy's roaring, all those sorts of things. So we know that in a way we're comparing apples and oranges, but the reality of it is the trade situation is going to have a big impact on both markets, and we think that both markets have overreacted. The stock market is probably a little overpriced. It's probably not discounting the risk of the Chinese trade deal not occurring, which we don't think is going to be the case. We think the trade deal will occur, but we wonder if the trade deal is going to be quite as significant as the stock market is expecting. So in short, we may be looking at a scenario in which the stock market is overpriced and the grain markets are underpriced, and as the news of the trade deal come out, we think that these markets have a decent chance of reverting to some sort of an equilibrium price or some sort of a mean. In the S&P, that might mean 2,600, 2,650, or maybe even a little lower. In soybeans, we might be looking at the high $9 or maybe even $10 in beans. Let's look at these charts individually. This is a chart of July soybean futures. As we can see, the soybean futures are trading roughly in the 830 area after sliding all the way into the 8. Specifically, it looks like we got down to about 817. This is really, really cheap for soybeans, and we all know that just because a market's cheap doesn't necessarily mean it's going to go up. But the odds of it going up from cheap levels are far greater than it going up from expensive levels, obviously. Further, the thing about commodities is the cure for cheap prices is cheap prices. When prices get cheap, farmers adjust their behavior, consumers adjust their behavior, and eventually prices suddenly aren't as cheap as they were because everybody's adjusted for the new reality. And prices swing on equilibriums. They go from expensive to cheap, and they do it almost annually. An indicator that we like to look at is the RSI. The RSI is Relative Strength Index. It shows us when a market's overbought, when it's oversold, when it's trending, so on and so forth. Obviously, if you look at the RSI, we're in oversold territory and we're trending lower. However, we've only seen the RSI this oversold one other time in the last 3-4 years, and that happened to be in June and July of 2018, about a year ago, almost a year ago. And at that time, the market rebounded pretty sharply. Obviously, the gains were short-lived, but we saw a run from $8.60 to $9.50. $1 in soybeans is a pretty substantial deal for a futures trader. We wouldn't be shocked to see soybeans run back up into the $9.60 area, and maybe if fundamentals shift dramatically, for example, if we have some sort of a weather scare, things get too hot or too cold or too dry or too wet, we wouldn't be shocked to see $10 beans again. That might seem impossible today because, remember, the last time we saw $10 beans was before the trade situation, but things can change quickly. This time we're taking a look at the S&P 500 futures contract. This happens to be a weekly chart, so each price bar depicted on the chart represents a week of trade. I know that the stock market's been a little rocky in the last couple of days, and so people are starting to panic's not the word, but people are starting to feel a little bit uneasy and wondering what's going on. But the reality is, even with the recent pullback, stocks are still really, really expensive. There's an internal trend line in the S&P that would probably suggest a correction when it does finally occur. Could see the 2680 to 2650 area, and that's this mark right here. If that level breaks, we could see 2450, and even then wouldn't necessarily demote the bull market. We'd still be in a bull trend. If you notice, if you're looking at a weekly chart and you're taking a step back to see the really big picture, even 2450 would mean higher lows. So with that in mind, we're looking at the upper end of the trading channel here, thinking that there's probably more downside risk than there is upside potential. Now, we happen to think that there's probably a pretty good chance that the S&P tests 3,000. We've come this far. Why not now? Maybe even 30-30. Markets like to run stops. People tend to have fear of missing out. They chase markets, and market chasing often leads to slightly higher highs, even if the market is going to eventually fail. So in our estimation, we're looking for the S&P to run out of steam, and we're not looking for a crash by all means, but we're looking for it to simply pause or digest some of this rally, somewhere between 2960 and 3030. So far, 2960 is holding, but only time will tell. We'd like to point out that the RSI, or the Relative Strength Index, on a weekly chart in the S&P is nearing 70. We're not quite there yet, but we're getting there. So you want to monitor that. If that gets up into the 70 area, the odds of the market going higher from those levels are pretty slim. It's not impossible. In fact, we've seen it once before. In early 2018, you'll notice this spike here. The RSI spiked all the way to 91. I've been doing this for a really, really, really long time, and I've never seen the stock market do that. Maybe it happened in 2000. I don't know. That was a little before my time. But that was something that, honestly, I'll probably never forget, and hopefully I don't experience again, because it took a lot of people by surprise. That said, anything in the RSI over 70 is probably a warning signal that the market's a little bit frothy.